All right, welcome back to Retire Stronger podcast, episode 7, Bill. This is tax optimization part 2. So, again, welcome back and happy St. Patrick's Day.
Yeah, happy St. Patrick's Day to you as well, John. And another exciting topic here for the listeners. I hope everyone has their popcorn popped because we're going to get into some tax optimization today in a bit more detail than the overview of our last session.
Absolutely. So, we're going to go over some broad topics today. Some topics may be beneficial for certain listeners, and they may not apply to or work for others. So I think it's always good to give the obligatory, um, you know, message of always consult your tax advisor and or attorney and or qualified financial planner to discuss these topics to make sure that they are appropriate for you or to find out whether they are appropriate for you. So, um, with that said, we're going to go over, like I said, various topics. Minimizing taxes in retirement is essential for um, maintaining an appropriate lifestyle and being able to keep up with inflation. Um, and just being able to live a comfortable life during retirement with respect to your income planning. So, between strategically managing your withdrawals, your investment accounts, your spending, it's very possible, and you have good potential for reducing your tax burden in retirement. So, what we're going to go over today is a pretty good look at various tax minimization strategies in retirement. So, Bill, I'm going to let you kick it off and start us off with this.
Sure, John. Thanks. And we've got a lot of points to get to, so we'll try and hit these here as quickly as we can, but obviously as comprehensively as we can as well, because there are a number of things that you can do with your finances, with your accounts, as it relates to optimizing your tax situation. And it has long been our contention, certainly not a guarantee for everyone, but long been our contention that the biggest expense you will face in retirement is likely going to be related to taxes and probably not related to healthcare. And if you're not aware of this or what your situation looks like, it's probably a pretty big deal for you to look into. So let's talk about some strategies you can employ right now or be looking to employ in the future with relation to your retirement income planning that can help optimize or minimize your tax situation going forward. So the first one I want to talk about is the withdrawal order on your money. This relates to which accounts do you use to take money from to fund your income needs in retirement. Now, this is not a guarantee, more of a rule of thumb, because frankly, I've seen this work in different orders for different people. But in general, if you organize your accounts by their tax status and draw from your taxable accounts first and draw those down, and then move to your tax deferred accounts like your IRA, 401k, all of your pre tax funds. And then third on the list, look at drawing from your tax free accounts like your Roth IRA, Roth 401k. This, generally speaking, is the best strategy or the best rule of thumb for withdrawals. Now, this doesn't mean that you can't blend your withdrawals between these different types of accounts. And you have to also count in here what your Social Security benefit is going to be, when are you going to take it. All of these are different chess pieces on the chessboard you have to consider when doing this. And as I said earlier, I've actually seen this work in reverse order, where sometimes for some people it makes sense to change that withdrawal order and organize by using their Roth funds first and using their pre-tax money last. Everybody's situation is going to be a little bit different. Certainly makes sense to analyze this and maybe find a qualified person who can help lead you through this based on your situation. But that's kind of the initial rule of thumb related to that. And overall, just knowing that you probably can make an impact on your tax situation just by which accounts you use and in which order you use them based on their tax status. So, number one, tax efficient withdrawal strategies is the order of withdrawals on the accounts.
Yeah, great point there. And I will tell you that this is a question we get often from clients, current clients even that are starting to approach retirement. And we are working through how we're going to fund their expenses in retirement once they're no longer earning an actual paycheck that they're getting from a job. So this is a concern for everyone, is figuring out what is the best strategy to pull the money, where to pull it from, how to do it. So I would tell you that this being as big of a deal as it is, if you have questions, please reach out to us at info@crownadvisorgroup.com. And again, we'll have that information up for you later in the show notes. You can always reach out to us and ask questions if you have specific questions on your own personal situation. So, moving on to the kind of the next way that you can minimize taxes in retirement potentially, strategic Roth conversions. I know we've done, Bill, you and I have done a podcast on Roth conversions already. So I believe that is episode 4. If you haven't listened to that, please take a listen. You can also go to our website and see some different articles that we've been quoted in national publications around this topic as well. But I think that one of the things a lot of people think on when they hear Roth conversions is they assume a lot of times, not everyone, but we do get the assumptions that come our way where people think they have to convert 100% of their traditional IRA or tax deferred 401k plan to a Roth all at once, and that's just not the case. So being smart about the way you go about doing a Roth conversion can be very beneficial for you in retirement, especially if you take advantage of your lower income years. We have a good number of clients that are their income is based on their sales, they're in their sales career, so their income fluctuates on an annualized basis. And, just one specific client comes to mind. We're working on some Roth conversions right now. We are taking advantage of a year where he knew that income was going to dip a little bit because of certain things that have been going on in his industry and some time he had to take off away from the job. So we're taking advantage of that lower tax bracket he'll find himself in this year. And we're doing some Roth conversions to help move some of those tax deferred dollars that he will have to pay taxes on later in retirement. Go ahead and move that to a Roth, pay the taxes on it now while he's in that lower bracket, and fill up that lower bracket without bumping him into a higher tax bracket in order to do a Roth conversion on a partial amount of his tax deferred funds. So this also comes into play when managing your Medicare premium surcharges, otherwise known as IRMA. If you have questions on that, please reach out to us. Again, info@crownadvisorgroup.com. We're happy to discuss that in more detail, but this is a big one as well. You don't have to convert 100% of your traditional IRA or 401k plan funds to a Roth IRA all at once. You can do this and you can spread it out over time. There's no limit on how many, how much or how little or how many times you can do a Roth conversion over the years.
Absolutely, John. So, point two, strategic Roth conversions, definitely something to look into. John, the next point here, number 3, is going to require us to go on a little bit of a field trip out to the tax farm because we're going to do some tax loss harvesting here. If we do some capital gains management as point number 3 here, it can often help on a year by year basis to potentially reduce your taxes. So, tax loss harvesting is simply offsetting capital gains that you have in investments by selling investments that have a capital loss. You'll want to obviously check with your tax preparer on how this would work for you and what the limits are, but definitely tax loss harvesting can help in given years to help offset your tax burden in here as well. Now, keep in mind too that people that are in lower tax brackets, lower income, the 10%, 12%, typically have a different situation here. Their gains may be taxed as little as 0 in those given years. And there are thresholds you can get to. If you stay under those, you could actually be in the 0 bracket, if you will, for capital gains in that particular year. And then the other thing to keep in mind always with capital gains is the length of time that you hold your investments can have an impact on what your overall tax bill is anyhow. Again, this is just something that with a qualified investment manager, a qualified tax professional can help lead you through if this will work for you and what the benefits will be, if any, in your particular situation. John, the next part 4 on this one that we want to go through is required minimum distribution management.
Yes,
Required,
big
min-
one.
required minimum distributions are the amount of money that the IRS requires you to take out of your pre-tax accounts, your IRAs, your 401ks, when you hit a particular age. Currently, that age is 73. 73, right? Yes, and it's going
That's
to
correct. Yep.
75 by 2030, I believe, is the year. So it is incrementally moving up. So if you turn 73 in a particular year, you will then be subject to the RMD requirements. So there's some qualified charitable distributions you can take. If you make a contribution or you send your RMD to a charity, that can offset the tax burden in that particular situation. John mentioned earlier about doing the Roth conversions. Well, this can help later on with RMD requirements because you do not have a required distribution from a Roth account. So
Correct.
this can help lower what your RMD requirement would be. It's a great thing to analyze when you're going through the Roth conversion because you can compare, if you have the right tools to do it, you can compare what would my RMD look like in the future versus what will it look like after doing that Roth conversion. And then if you're still working past age 73, you can actually delay your RMDs from your current employer, from your 401k plan, if you don't own more than 5% of the company. Okay, so there
Yep.
are some little tidbits here in the rules of RMDs that might apply to you based on your age and based on your employment status as well. So there is a little bit of strategy here related to RMDs you might want to look into to help minimize. And you start to see also, John, how these pieces fit together, how
Hmm.
Roth conversions help impact the RMD status, and so on and so forth. So uh, those are the next two there in our list. John, I believe number 5 is to optimize your Social Security benefits. Did you want to say anything about what we just went through here?
Yeah, I'll just tack on the fact that it's pretty apparent that there's a lot of different options, ideas, ways, things you can do. And if you're not aware of these things, or if you're not working with an advisory team, and now I say the word team because that includes your financial planner, it includes your CPA, and potentially even an estate planning attorney to help you with making sure that you're not making missteps with your strategy leading up to and through retirement. So there's a lot of things that can be incorporated to make sure that you are taking, the most, or getting the most potential, you know, optimization of your tax scenario during retirement. So just make sure you're working with a team of individuals that can help explore all these different ideas with you and make sure you're taking advantage of them where possible. So yes, moving on to the next topic here, number 5 on our list here, optimizing your Social Security benefits. Timing your Social Security benefits can be crucial. If you delay Social Security benefits until age 70, your increase on the amount that you're going to receive, as it stands right now, will go up by 8% annually from your full retirement age, and it will cap off at age 70. This if you delay, if it makes sense to delay, this will keep your taxes on your income lower until you start receiving that Social Security benefit. Also, your spousal benefits and taxes. Coordinating claiming strategies with a spouse, ensuring efficient tax management. For example, if one spouse, may delay claiming benefits for a higher payout while the other claims earlier, these are different things you can do. There are other variations of ways to claim and coordinate with that, with your spouse, that might make sense for your situation. Um, but a big one for a lot of our clients is provisional income management. Your Social Security benefits do become taxable to you if your provisional income, which is your adjusted gross income, or otherwise known as AGI, plus your tax-free interest that you could be or possibly are earning. And then they add in half of your Social Security income that you're receiving. If that exceeds certain thresholds, your income from Social Security can be taxed. So managing withdrawals and Roth conversions can help keep your provisional income below these thresholds and can keep you from potentially paying taxes on that Social Security income. A lot of folks just are shocked when we tell them that their taxes from their municipal bonds are going to be counted against them when determining what their provisional income is for Social Security taxation. I know you're going to talk about that here shortly, but that does seem to surprise folks a lot of times. Anything you want to add in that section?
Just just that, I would say upwards of 90% of the people that I've spoken with over the years have no idea about the provisional tax brackets as far as how it relates to how your Social Security benefits are going to be taxed, how those were created, the history on those, how they are not cost of living adjusted and haven't been since 1982.
Right.
So every single year they scoop up more and more people into those brackets. So that is a critical piece in understanding. Okay, well, how do I organize the rest of my money so that my provisional bracket situation is as low as it possibly can be? And that is part of the strategy in tax optimization that, again, all the puzzle pieces are starting to fit together here.
Yeah, and there's no guarantee that you're going to be able to avoid taxation on your Social Security benefits. And we're not tax advisors; we cannot give tax advice. So that is an area that will help you work with your CPA or tax advisor in making sure that we're doing everything we possibly can to keep you from having to pay taxes on Social Security. But um, it may not be avoidable, unfortunately. And I might as well just jump right into that and let's just talk about it. Right, utilizing tax efficient investments, number 6 on our list. So muni bonds and municipal bonds. I just mentioned how the interest free income on those can go against you potentially when calculating Social Security taxes, if there would be any. So, like I mentioned before, interest on municipal bonds is generally tax free, depending on, at the federal level and potentially at the state and local level. Um, but it all depends on who you bought the bond from, where you live, etc. So make sure you understand what you're buying and why you're buying it. These are certainly attractive investments or can be attractive investments for higher income earners during retirement and can provide a nice source of retirement income. Um, Again, you just have to be careful and watch out for the fact that tax-free income can count against you for uh, your uh, your Social Security taxation threshold. Um, Tax efficient funds in investing in tax managed mutual funds or exchange traded funds that are designed to reduce tax distributions and minimizing turnover and tax triggering events. This can also play a nice role in helping you manage your taxes in retirement. I would tell you that, um, Bill, what would you say? Probably the bulk of the assets we manage are either in individual stocks, individual equities, or ETFs. We typically stay away from most mutual funds due to some disadvantages that mutual funds bring to the table, especially in a taxable account when it comes to tax management in retirement. One of the big ones is the pass through taxation on mutual funds, whereas an individual stock or ETF is only taxed once you sell it for a gain. These are just some of the things we'll look for and we'll want to pay attention to for tax efficiency in your retirement plan, your income plan, and your investments. And then consider using bond funds in tax deferred accounts. Place bond funds in which generate regular interest taxed as ordinary income, mind you, in tax deferred accounts like traditional IRAs or Roth IRAs. But we love to see typically equities and equity ETFs typically held in taxable or Roth accounts. So again, utilizing tax efficient investments in your strategy can help minimize taxes in retirement. Bill, anything to add to that?
No, I think you covered that really well. It's just another example here of not only how the parts and pieces fit together. That's kind of the overall theme here, but how the investment strategy and the investment strategy that you create and employ has a big impact or potentially a big impact on what your overall tax situation looks like. And you can use some of these levers to really attack your tax situation over time.
Absolutely.
John, I think the next piece here, kind of shifting gears, is one that's somewhat near and dear to our hearts. It's the health savings account taxation tool here. And if you don't have a health savings account, maybe you're still working, you're approaching retirement, you're not sure if you qualify for a health savings account, contact us, send us an email, info@crownadvisorgroup.com. We can help you navigate those waters. But health savings account are just a great tool really for anyone who qualifies for one. They do offer a triple tax advantage in that your contributions are deductible. The growth inside the account is tax free. And then if you use the money inside the account for qualified health expenses, there is no tax on that distribution. And then at age 65, you have to remember that this account does convert to a traditional IRA, which then can be used for any purpose. However, distributions for non-medical expenses over age 65 are taxed as ordinary income. So you can still use it as a health savings account and get the tax-free benefit from it over that purpose. But the other thing to think about too, if you're in retirement and you have a health savings account, one thing you can consider doing is delay using your money inside your health savings account, pay out for other expenses out of pocket, medical expenses, maybe lower value expenses, and save the money, let it grow in here for expenses later on that might be a little bit heavier for you. More major expenses out into the future. So leveraging your health savings account would be something to look into as far as not only just tax deduction on the front end, but how you can use it to offset taxes on the back end as well.
Absolutely. I really don't have anything to add to that. You covered pretty much the basics there. For sake of time, I'm not gonna go into a ton of detail on this next topic because we covered a lot of it already. Tax bracket management is number 8 on our list. We already mentioned filling up your lower tax brackets during low income years, and potentially using Roth conversions here to help you with that. Um, and then that also helps you maximize your standard deductions in retirement years as well. Um, so, when you hear us talk about tax bracket management, that's what we're referring to: maximizing your standard deduction in retirement and utilizing lower income years to potentially look at you know uh, things such as a Roth conversion to fill up that lower bracket and not pushing you into a higher bracket. That's the key. So there's not too much more I want to cover there. We've covered a lot about that already. Anything you really want to add on that, Bill?
No, I don't think so. I mean, if you go into that much further, we're going to open up a rabbit trail here that we could go down for
Yeah,
hours, right? And I think that's what you're getting at in here as well. And again, there are strategies inside of the tax bracket management that you can utilize. But sometimes just understanding what bracket you're in now, and then understanding, well, if I make some of these changes that we've discussed in here, or if I utilize some of these strategies, what will my tax bracket look like potentially in the future? That's really what I think most people want to know.
absolutely.
So the next topic here we have is estate and inheritance tax strategies. Again, this is another one that we could go down for hours and hours. I'll only take about 2 hours to cover this part, John, and then we'll move on from there. No, there are some simple things. Using Roth IRAs as a legacy strategy. There's the Roth IRA again. Roth IRAs really are a multi-generational strategy.
Yeah,
They
I agree.
can be for many families because if you have a Roth IRA, if you do Roth conversions and you create these accounts, you can actually pass these on to your beneficiaries tax-free, provided they've been open for at least 5 years. So this allows your beneficiaries, perhaps your children, perhaps your grandchildren, to inherit some of your money tax-free. And that's really hard to do in our tax environment right now. That's a big one. Some other estate things that you can do: gifting strategies. Know what the annual gift exclusion is, money that you can give to your heirs tax free. Right now, well, in 2023, it was 17,000. I think it's up to 19,000. John, I don't have it in front of me. We'll put that in the show notes. What the 2025 number was increased to, but the gift tax exclusion can help you pass money to your beneficiaries without paying tax on that. And then the third big one here is contributing to a 529 educational plan for your grandchildren um, or other heirs. It allows you to provide them with money for educational expenses on a tax free basis. Just keep in mind that there are some negative factors related to 529 plans as it relates to merit based aid, that type of thing with college planning. So you want to look into that as well. But for you passing money to others, you can do it in this fashion, um, generally on a tax-free basis. So there are some estate and inheritance strategies. We like to work hand in hand with our estate planners, our estate planning partners, and our clients. I feel like that's a good relationship that you need to have, even as just an individual. Find a good estate planner you can trust, and they can help walk you through what are the gifting strategies that I can do, what are the charitable strategies I can do, how do I make sure that my Roth account is going to go to my beneficiaries the way I want it to, with there. So just a little plug for our estate planners.
Absolutely. They do great work. And we have found many times where they have had a big impact on our retirement planning for certain clients. So it definitely makes sense to at least discuss these topics if you think they may apply to you. All right, to wrap this up, I'm going to cover the last two topics for us here. One would be, or the next one, number 10 on our list here, relocation and state tax considerations. Why do so many people retire to Florida? Well, there's no state income tax in Florida, at least not right now. And I
I
don't
thought it was
foresee
just the warm weather. Isn't it just the warm weather,
it.
John?
That too.
And Disney World, Disney World.
Better climate, and especially the no state income tax. That's also true in Texas and Nevada as well.
And
Um,
Tennessee.
yes, so there's things you can consider there that can help save money in retirement, help lower your taxes you might have to pay, and help your dollar go further as you are now going to be on a more of a potentially a more of a fixed income strategy. So that's one thing you can look at. Also, certain states will have specific income exemptions or tax exemptions. You know, take a look at the state you're in now. Look at all of the different income tax exemptions or options that you may have available to you. Determine whether or not it makes sense to stay where you are. Um, it may make sense to make a change or make a move to take advantage of some better opportunities and better tax law. Excuse me, better tax laws. So that is something you definitely want to take a look at. Um, Bill, I don't know if there's anything else you want to add to that topic, but I think it's pretty straightforward. Um, so number 11 on our list, and the final one on our list for today is charitable giving and tax savings. Um, some of our clients utilize donor advised funds. This is a great way to establish a charitable giving fund that you can give to during your high income years, maximizing tax deductions. And the funds that you contribute to a donor advised fund can grow tax free and be distributed over time to charities of your choice. So this is certainly an area that a lot of our clients will take advantage of when possible and when necessary to help with tax deductions. And it's great because they may not have a specific charity they want to donate that money to right now, which this gives them the opportunity to control that donation over time. And then bunching deductions. When you bunch charitable deductions and other deductible expenses into a single year to exceed the standard deduction, that allows you to maximize and start itemizing your deductions, which can give you a larger tax break off of your income for that year. So if you know that you're going to have a year where your income is going to be higher than normal potentially, and you do want to possibly uh, donate more to a charity that year, or um, use your spending and your expenses in a manner that allows you to generate a larger amount of deductions over and above your standard deduction, this could be a helpful way of utilizing higher tax breaks, potentially. So obviously, consult your tax advisor on that piece. Bill, anything to add on those?
No, and we talked about several times here how these pieces fit together. The other thing that fits together here is that it really does help to have a team of folks who are your advocate, who are looking out for you, who understand your financial situation. And that's not going to be likely just one person. We
Mm-mm.
keep saying a team of folks because it generally takes a team of people in different specialties who understand the tax code, who understand estate planning, who understand investments and insurance, on all of those pieces as well, to make this work as efficiently and get this machine running as efficiently as you possibly can. Look, what we've talked about today, John, from a 10,000 foot view, by carefully selecting withdrawal strategies, using tax efficient accounts, leveraging the tax code, retirees can effectively manage and minimize their taxes, right? You can't guarantee what those numbers are going to be, but you can
No.
start to see trajectory changes in what you're doing, that will change the path that you're on to potentially reduce the tax burden overall. It's always wise to consult a tax or financial advisor, really to tailor these strategies to your individual retirement plan and ensure that you can maximize your after-tax income and preserve your wealth. And then ultimately, what we always talk about is, at the end of the day, any changes and improvements that you make, we want these to serve a larger purpose. We want these to bring peace of mind, right?
Mm.
If it doesn't bring peace of mind, or if you don't understand what you're doing, you probably shouldn't do it. So start there. Find people that you can trust to help you in these areas, and you can have a big impact on what your future finances will look like.
Absolutely. I'll close it with the fact that, we talked about a lot of different things you can do today. And, these are things that may work right now for you, but you have to make sure you're continually, you know, evaluating the structure of your financial plan, your financial income strategy for retirement. Um, every so often, if at least annually, to make sure that that plan of action is still going to work for you based on why you implemented that plan in the first place, because things change, tax laws change, different different people get elected to office, and rules and laws get enacted and put into place, every so often, that could possibly impact what we're doing. So it's always good to continually review what you have going on with your plan to make sure that it's still appropriate for your situation. With that, I'm going to sign us off, Bill, unless you have anything else to add. And
I don't, John. It was great to be with you today and go over this exciting topic. And I'll look forward to being with you in the audience next time.
Absolutely. All right, everyone. Thank you for listening. If you have any questions, again, you can reach us at info@crownadvisorgroup.com. And that's advisor with an OR, crownadvisorgroup.com. We look forward to seeing you next time. Have a great day. Bye bye.